Welcome to the Cashflow Ninja, the podcast sharing how to create and grow income streams and manage, multiply, and protect your wealth in the new economy. Are you tired of trading your time for money? Do you desire freedom today instead of retirement in 10, 20, or 30 years? I'm MC Laubscher, and this is the Cashflow Ninja. This is Cashflow Ninja. I'm MC Laubscher. Thank you so much for joining me in another episode of the Cashflow Ninja podcast. Please check out all of our past episodes. There's over 650 of them now at cashflowninja.com. We have a ton of tools, resources, and a lot of information about our community. Everything available at cashflowninja.com. I've got another fantastic show with a great guest, returning guest on the Cashflow Ninja show. He's been on the show a number of times, Mauricio Rauld. If you go to cashflowninja.com and search for Mauricio, you'll find all of the other previous conversations that we had. I would highly recommend you check it out. Mauricio, great to have you back. How have you been?
Always good to be here. Thank you. Been good. Been, finally getting back in the swing of things, which is nice.
Absolutely. Now, for new listeners and viewers not familiar with you and what you do, can you please just give them a little bit about your background and journey?
Yeah, I mean, look, I'm a syndication attorney, which is just a sort of a common way to say I'm a securities lawyer, right? So my job is I typically help real estate investors raise capital. You know, real estate investors who are looking to scale their business and they want to jump from single family homes to something bigger, multifamily usually, or other asset classes, but they want to go raise capital now to go do those bigger deals. And my job is to make sure that they do that in full compliance with federal and state securities laws. And I'm known a little bit like the anti-lawyer just because, I'm actually, my buddy Tom Wheelwright likes to say, I'm one of the few lawyers that actually speaks English. So that's kind of my little thing where I tend to be able to explain these like really esoteric, mundane statutes and stuff and just make it a little bit easier to understand so that the audience can at least get the context and contextualize what exactly is going on so they can have intelligent conversations with their own attorneys.
Absolutely. Make it very, very palatable and interesting. And Mauricio is also a great teacher. He's part of a lot of different communities and so forth. And he teaches in the Secrets of Syndication workshop and course that the real estate guys offer. He's one of the leading teachers in that program. So honored to have you back on and talk a little bit about it, because one of the things that you alluded to when people are starting to raise capital for deals, this is where your expertise come in. And if you really want to break it down of what you do, is you keep people out of prison that's raising money, and they might not even know that they could go to prison, right?
Yeah, that's actually, I finally wrapped up my book, The 5 Things Every Syndicator Must Know to Stay Out of Jail. And the first thing that I talk about in chapter 1 is people not even realizing that they're issuing securities. They're like, wait a minute, why do I even have to worry about the SEC? I'm just buying a piece of property. I'm buying my little single family or multifamily. What is this business about securities? Why do I need a securities lawyer? Yep. And as I explain in the book, the definition of a security is really broad under the SEC. It includes everything that you think about as security: stocks, bonds, mutual funds, all that stuff. But it also includes, TIC agreements or, profit sharing agreements, handshakes, high fives, side agreements, anything. The structure itself doesn't matter. And I think that's what gets people caught up a little bit. They call it a joint venture. They call it a note. They call it something else. But at the end of the day, if you're raising capital from passive investors where the returns are generated by your efforts, you're doing all the work, your investors are just writing a check and going home, that's a textbook definition of a security. And once you realize that, then you got to go through all the compliance, rigmarole.
Yep. Absolutely. And I think that's the biggest thing for folks out there that might not even know that they're involved with the security and could end up in prison, and they were just engaging in the business of real estate. So some of the other things that syndicators should know to keep them out of prison. One of the things, I think this one might be an interesting one. In one of the chapters in your book, you talk a little bit about advertising and how the SEC, the Securities Exchange Commission, really has a zero tolerance policy If maybe you want to share a little bit more information on that, because I see a ton of stuff on social media. So a lot of folks, again, might not even know that they're not supposed to do what they're doing.
Yeah, and look, let me just preface a little bit. I chose a kind of a controversial title, obviously, to get some attention. The odds of you going to jail are very slim unless you're defrauding. I mean, if you're intentionally trying to take your investors' money and defraud them, that's when you end up with the stripes. Usually, if you're violating something, but my point is that they're serious. Like, violating securities laws are very serious business, and people kind of take them lightly, which is why I really wanted to get people's attention with that. But yeah, let's talk about advertising. Just to be current on this podcast, we just found out yesterday that our good friend, Grant Cardone, who, as you know, is a really well-known, not only a real estate investor and developer, but also big on social media, right? And he's gotten into a lot of hot water with his advertising on social media, and he's actually allowed to advertise, right? So as we talked about in other episodes, and I encourage people to go check those out, once you realize you're dealing with a security, you got to pick an exemption, because nobody's going to register the security. So you pick an exemption, and most people pick an exemption that prohibits advertising. So that's kind of what we're going to talk about in a second. So we pick an exemption called the 506B, which is what 95% of people pick.
We are living through unprecedented times, and many experts say that in the coming months and years, we're about to see some of the best real estate opportunities of our lifetime. Who's going to benefit the most from these opportunities? Those with access to capital, which is where the Real Estate Accelerator comes in. Brought to you by Good Egg Investments, the Real Estate Accelerator is an online course and mastermind that will give you everything you need to raise private capital for real estate syndications. Through building a killer brand that attracts the right investors, you'll be able to take advantage of the upcoming opportunities and scale your business. To learn more, check out cashflowninja.com/goodegg.
And it's a great exemption, but your big limitation is you cannot advertise, so you cannot go on social media. Grant Cardone uses a different exemption that actually allows him to advertise, and he's still got into issues or is still getting into hot water. There's a class action lawsuit now against him because the way he was advertising, even though he was allowed, was very allegedly misleading. He was promising things that he didn't have a reasonable basis to believe in, or was really kind of exaggerating, or maybe left some things out. So even when you can advertise on social media, you've got to be careful. So even you guys out there doing 506Cs, don't think that's just a blanket permission to go do whatever you want. But let's go back to social media. I think chapter 3 of the book talks about, or maybe it's chapter 2, talks about, realizing that you cannot post things on social media or do what we're doing. If I have an offering and I'm selling my syndication, I can't go on your podcast and talk about my deal. And I can't even what's called condition the market. So I can't even get people excited. There's ways that you can communicate where you don't actually specifically reference the deal, but you can tell that you're kind of drumming up interest about either your current deal that you've got going or maybe a future deal that's around the corner. Maybe you're talking about prior returns and how awesome you are and how your investors are doing really well with what you're doing. And hey, we have another deal around the corner. And that's where people, I think, get into a lot of trouble with social media. My recommendation, hands down, is if you have an active deal, something that you're actively raising money for, I would just stay off of social media. Too many gray areas, and the risk, I think, and the risk-reward ratio just isn't there. Yes, post about your family and your kids and your cats and your dogs or whatever, but just I would just stay off and talk. If you're a real estate investor, syndicator, just stay away from that. In between deals, when you're not having something officially, then there are certain things that I think are okay to post on social media. For example, factual information about you or your company is always a green light. I mean, the SEC recognizes, you've got a brand, you've got a business to run, and certainly talking about you, your brand, or even sometimes just what you're up to in the company. If you've got whatever your deals are, properties are. But the other one, which is my favorite, which I know you will agree with this as well, because it's what we do, is just value add, right? Post things on social media that not only don't talk about a deal, that really don't talk about you at all, but it just adds a ton of value. So for example, nothing wrong with posting, why real estate, if that's your thing, why real estate is the greatest asset class of all time, why mobile home parks, or why multifamily is a great asset class, why Florida is a great marketplace, why Dallas is a great marketplace, why whatever. Pure value add people, it's something that people really find interesting, that are willing to actually, exchange information, cell number, your phone number or an email to get that information from you. And then you've got an email, right? Then you can start having a conversation with them offline. But if you go, I think it's chapter 4 of the book, we go through, like, there's some steps that you need to take once you kind of meet them legally, take them off social media, or if you meet them at an event, or you meet them at the coffee house, whatever. There's about 8 steps that you want to take them through to really get to know them. Because the way around, and that sounds nefarious, the way you avoid the allegation that you advertise is by having a substantive relationship, a pre-existing substantive relationship with your prospect. And that means you've known them for a while, and you've gotten to know them really well, and you've figured out that they're sophisticated.
Right. So on the Cardone thing, that's Grant Cardone, and he's known for, as the Icarus, always flying close to the sun. The wings are going to melt at some stage. But and obviously he puts a lot of stuff out there. I don't know how he's able to do it. He's constantly on social media. But so there was you mentioned there was a class action lawsuit, and this was just of the way that it was presented, and he was raising capital. Yeah. Did it have to do something too that he was raising capital from non-accredited investors too, or
no? So he's allowed to do that. So originally, if you follow Grant, if you notice, he was only selling to sort of high net worth individuals. In fact, originally his minimums were $250,000 because he was literally selling to high net worth. He was relying on an exemption that a lot of people do rely on, which is a 506C. 506C allows you to advertise, allows you to do all this social media stuff. It just limits you to accredited investors only. And you've got to verify. You can't just take their word for it. That's 506C, which we talked a lot about, I think, in our first episode. Grant actually then pivoted a little bit, and I don't know if he continued to do 506Cs, but then he started doing sort of a mini registration where he's allowed to actually, once he gets it through the registration process, which takes about 6 to 9 months, he's allowed to then advertise, and he's allowed to accept non-accredited investors with some limitations, 10% of the net worth or the things. So that's how he was legally getting people in the door. And thousands. I think I was looking at the complaint, and I think one of his funds had over 2,000 people, and a lot of them put in $5,000 or $2,000. Like it's really, you're dealing with a lot of small amounts. But he's allowed to do that under this exemption called Reg A, Regulation A. From at least what I can see from the allegations, what they're complaining about is just he got a little. They're alleging he got a little bit got a little too excited about the way he was presenting stuff, and he was kind of promising the moon. He was like, "Hey, invest with me." I don't think he ever used the word guarantee, but hey, I'll get you 15% here. I'll triple your money. Those kind of statements, which can be construed as misleading. So it's not the fact that he advertised; it's the fact because he actually got an approval from the SEC to do it. It was more about the allegation that he kind of misled the public. When he was making his social media posts and promising the world when he really didn't have any basis to believe that. And now, of course, with COVID and everything, everybody's having a little bit of a hard time, hitting those numbers because, right now everybody's just trying to stay afloat and try and keep distributions going, So anyway, so that's the thing with him. But the lesson for me there is more about, even when you're allowed to advertise, there's a lot of landmines that you have to navigate. What I talk about in the book is when you can't even advertise, period. Right, which is the 506B. Don't even try and get queued. Here you can advertise, but that's not just because you can advertise doesn't mean you can just post anything you want. You still got to be careful about these anti-fraud provisions.
Yeah, and I think the other lesson that's there too for folks listening is that you need to absolutely know what you're investing in. I think that sometimes folks get caught up emotionally into some advertising or promises or returns and that kind of stuff. When you're investing in real estate, to your point, we had a pandemic hit earlier this year, and now you have operators, which good operators have contingency plans, and maybe some of them, because they're good stewards of capital, looked at the big picture and said, All right, we're going to hold off on distributions until we figure out what's going on, how long this is lasting, look at our rent collections, cut expenses, renegotiate contracts, do all the things that good operators are supposed to do. But now all of a sudden there might be folks that, wait a second, that didn't understand that that's even a possibility because, again, of a little bit of the hype and the misleading advertising. So I think one of the other core things too is always know what you're investing in and the downside and all the different angles, which should be sort of, under the 101 section, right?
Yeah, and even above that, I always tell when I'm talking to, passive investors who are looking to invest in one of these offerings is probably the most important thing is just doing your due diligence on the operator, on the syndicator, because it all comes down to their experience. Have they done it before? Are they good stewards of your money? Have they gone through a past recession? Have they had some hard times? How do they deal with hard times? I mean, you can probably make most of your investment decision first on the operator, the sponsor. Can they pull out? Because anybody can put together a business plan. The question is, can you execute on it?
Right.
And then obviously, once you're comfortable with the sponsor, then you start looking at the investment itself, whether it's the right asset class, if it's in the right market, the right structure. But that's where the due diligence comes in, which is super important. As a passive, you do all the work up front. Once you sign the papers and send the check in, you're done. But all the work has to happen up front, getting into those relationships with the sponsors, getting to know them, feel comfortable with them, and then obviously understand the investment that they're offering you.
Absolutely. Another one aspect that you cover in your book too is about the importance of understanding that it's a security.
There is a massive demand for affordable housing across the United States that far outpaces the current supply. More and more people will be renting in droves, and it's putting the squeeze on an already tight rental market. This provides a unique opportunity in a recession-resistant and also the highest yielding investment niche in real estate right now, mobile home parks. Four Peaks Capital Partners has been successfully investing in this proven recession-resistant sector for years, providing investors with predictable passive income and capital appreciation. Four Peaks Capital Partners offer private real estate investments for accredited investors to passively invest in this real estate niche. To learn more how to protect your investment portfolio and at the same time generate predictable income passively, visit privateincomeinvesting.com. That's privateincomeinvesting.com.
And that unlicensed people cannot be compensated, be paid to raise money for syndicators.
Yeah. So it's very tempting when you're raising capital, especially when you're starting and maybe you start in your first one, you get all your friends and family and people and you're able to put together a small syndication. But then when you do your second and third, and at some point it's very tempting when you need to raise a bunch of more money, when somebody approaches you and says, hey, I've got $1 million that I can pull together for you. I've got some investors over here and I've got relationships and they're looking for something. If I send you this $1 million or $2 million, can you compensate me? Can you give me a referral fee or can you give me a percentage of your deal or something like that? And what you have to keep in mind, which is what I talk about in the book, is the only people who can receive sort of what we call transaction-based compensation, which is just, hey, I'll give you money in exchange for you giving me, investors that invest with me, is if you're a licensed broker-dealer, which of course nobody, not that nobody is, but most people who have people to refer you to don't have that license. And so anytime you do that, you're violating the FINRA rules and the SEC rules regarding compensation to brokers. The way around that, and again, I use the way around, that's kind of nefarious, but obviously if you're the issuer, if you're the one who's putting this together and it's just you, then you're going to be the issuer and you're going to rely on an issuer exemption because you're not raising money for anybody else, you're raising money for yourself. And then even if you're the manager, the sponsor, or one of the executive teams that are raising money for the company, there's other exemptions that you can find, but you've got to be a real legitimate co-sponsor to get to fit within these exemptions. You've got to be doing real work. You've got to be doing what we call substantial duties. And your primary role better be something other than raising money. So it's just become a kind of a little bit of a pandemic, no pun intended, that started last year, or maybe I started talking about it early last year. And it's just becoming, just like this whole the Cardone thing's interesting, but actually the Cardone is a private cause of action. The SEC is looking very closely at this compensation model because a lot of syndicators are doing it. A lot of coaches are teaching it. Very open kimonos. They're not trying to hide anything, and they're just not realizing that what they're doing violates the broker-dealer rules.
Now, you'd mentioned earlier something about a pre-existing relationship. Yeah. With that, and you'd go into a chapter in your book too, because this is very, very important, because a lot of folks, again, there's a lot of things that they don't know. You don't know what you don't know. Maybe you want to elaborate just on the importance of knowing what constitutes a pre-existing substantive relationship.
Yeah, I mean, you don't know what you don't know, which is why I wrote the book, 5 Things You Must Know as a syndicator. Yeah, I mean, again, when you're relying on an exemption that does not allow you to advertise, the most common way that you prove you did not advertise is by having this pre-existing relationship, this pre-existing substantive relationship. And this is one of the few areas that the SEC has actually given us some really concrete guidance. Like the SEC usually is very, very broad. It's very gray. You don't really know what you're supposed to do. Here they gave you 8 steps. They're like, here are the 8 steps that if you follow these, and it's up to you to document it, it's up to you to do the work, and it's up to you to decide when you get to a certain point. But if you follow these 8 rules, then that's how you establish a substantive relationship, which then allows you to offer a future deal, because you still can't offer them any deal you have now, because you have to have a pre-existing substantive relationship, and that means pre-existing an offering. So once you start an offering, you can't bring any more people through this method anyway. And so the 2 most important ones is number 1 is you typically want to send them a really detailed questionnaire. And I decided to just attach to my ebook a questionnaire that I encourage people to use if they want to, or incorporate with whatever they have. But it's not just, hey, are you accredited? How much money do you make? It's a really detailed questionnaire that really tries to understand their financial situation, what their investment goals are, what their investment experience is. Very similar to when you open a brokerage account and you're trying to get an options account or a margin account, a detailed questionnaire. And then the idea is that once you have that questionnaire, that you get on the phone call or a cup of coffee or lunch. I mean, these days you're probably doing a phone call or a Zoom call, and maybe it's more than 1, maybe it's 2 or 3, where you're going through the questionnaire, you're asking all these questions of the potential investor. They're asking questions about you, what's your philosophy, what's your experience, and you're just generally fostering this back and forth where you're trying to get to know each other. As a syndicator, I want to know, are you sophisticated? Is this a suitable investment for you? Do you have the level of expertise and knowledge that you can evaluate the risks and the rewards, the merits of the deal? And then as the prospective investors, who are you? You're a syndicator. Are you any good? Do you have experience? What type of investments do you do? And then at some point you say, look, I got it now. This person, we've spoken enough on the phone. We've emailed each other. They've checked us out. We've checked them out. We have a substantial relationship. And then you can kind of, in my mind, you want to keep either a spreadsheet or a CRM, right? Some kind of database or something. And at that point, you can kind of move them in from this restricted pool of people that you don't really know very well, put them onto your kind of clean list, and your future deal, you can then start offering them deals.
And the other thing that you point out in your book a little bit too is talk about templates and using other people's documentation just throwing it all together, like you grab some duct tape and putting together something. Why is that a bad idea?
Well, the main document, which is the PPM, right? A private placement memorandum, that's a disclosure document. And I think of it, I always give the analogy of the PPM being like a medical consent form. Like when you go into surgery, they give you that yellow sheets of all the ways you could die or get infections. And that's what a PPM is. But in and of itself, the other analogy I like to give is it's like a pipe. Like, it's not that the pipe itself doesn't do anything. You've got to fill the pipe with something, right? And so you've got to fill that PPM with relevant disclosures, risk factors, disclosures about the deal, disclosures about you. And the only way you get the attorney, the only way I know how to do that is have several conversations with you where I pull that information from you. I ask you a bunch of questions. I go through your business plan. We tear that thing apart. We really understand your deal, and we can put all that information in the business plan that's relevant to your particular thing. If you just you can go on the internet and pull a PPM out, but it's kind of worthless. And I know people who have done that, because I know people who have used mine. I've sometimes shared templates of my PPMs, at events, or sometimes as part of a package I do, whatever. And I've had conversations where like, yeah, I just took your PPM and changed the names and I'm good. And I'm like, no, that's a very generic PPM. It's got some generic things, but it talks nothing about your particular deal, your particular loan product, your particular area, your experience, did you have a bankruptcy that you didn't disclose? I mean, failure to disclose because you don't know what you don't know. If you put out a document that omits or fails to provide information that you were supposed to provide, now you're in violation of securities laws.
Yep. Very, very, very important to have your own one. Now, the other thing that was very interested in having a conversation with you too, Mauricio, is there's recently been changes to the designation of being an accredited investor. Maybe if you just want to talk a little bit about that, what it entails, and the recent update and how it affects investors, how it affects syndicators.
Yeah. So they recently finalized rule. They actually came out with these rules back in December of last year. I remember posting about them, and they typically start with preliminary kind of, here's our temporary rules. They ask for comments, and then they come out with final rules.
Camaplan is one of the leaders for personalized tax-deferred and tax-free IRA planning. Camaplan's team can assist you to take control of your retirement funds and financial future through self-directed investing. They offer support to clients throughout the entire process, from opening your first account to making your first purchase to self-managing your assets. Camaplan works with a growing network of investment providers in all asset categories and offer free investor education through classes, events, and webinars with over 15 years of leadership and self-directed retirement investing. Camaplan will help you unlock a convenient and safe way to manage your retirement investments and discover financial freedom beyond traditional investments, beyond Wall Street, and go from forever taxed to never taxed. Start to take control over your retirement funds and financial future today by visiting cashflowninja.com/Camaplan.
And they came out with these last month in August. And so what essentially they did was really, they updated a lot of the little rules, but the ones that really affect us the most, because other things have to do with like family offices and things that you don't really pertain to most of us. There's really two areas. One of them, probably the most important or potentially important one, is that right now, for individuals, it's all income or net worth. It's your financials, right? You've got to have $1 million in net worth, excluding your primary residence, or you've got to have earned $200,000 the last 2 years with a reasonable expectation of earning that this year. A lot of controversy about that. It's like, well, why should money matter? I know a lot of rich people who are complete morons. I know a lot of people who are poor who are smarter than everybody in the room, right? So that may not be the best metrics. They finally come out and say, okay, we agree. We're going to have these certification programs where a non-accredited investor is going to be able to take some kind of a course or some kind of a program that's going to be given by an authorized, licensed certification institution. We just don't know what that looks like yet. And then at the end of that course, whether it's we don't know if it's a weekend course, if it's a week long, a semester, a year, we don't know what that looks like, but there's going to be some certification that you get at the end of that process that says now you are an accredited investor because you've just studied, you've passed an exam, and you're good to go. That's not there yet. It's kind of opened up the idea for that, but the SEC has not yet designated any institutions or any programs with that designation yet. So we don't have any idea what it's going to look like, and it certainly does not exist right now. What they did say, though, is they did the first little a group of people that would qualify, and those are people who are essentially investment advisors. People who already have these licenses. There are essentially 3 specific licenses I mentioned. It's a Series 7 license, a Series 65, and a Series 82. These are just different basic securities licenses that you can get from FINRA. And so if you have one of those licenses, you're good. You're in good shape. Once this thing takes in effect, which would probably be at the end of October, you're going to be accredited even if you don't fulfill the net worth or income requirement. And if you wanted to, in theory, like if you're a passive investor and you really want to invest in a lot of these deals, you could go get yourself a Series 7 license. I don't think it's that complicated. You've got to study for an exam and you've got to pass it, and then you've got to apply and become a member of FINRA, which has some compliance to it, right? I mean, that's the whole idea. But it's more of an exciting as the potential, because even though it doesn't exist now, somewhere down the line, whether it's next month, next quarter, next year, the SEC is going to periodically come up with a list of institutions and let us know, this is how you can become accredited. So that's kind of exciting. The other part that potentially could affect us, but at least for most of my clients, doesn't really apply, but I want to address it because people got excited about it. There's an addition to what's called a knowledgeable employee. If you're a knowledgeable employee, then maybe you would become an accredited investor, even if you're not, you don't have the net worth or income. The problem is, in our world, the issuer, the person who's raising the capital, they don't have any employees. They just created the entity. They usually create a brand new company, last week, and there's certainly no employees. I mean, usually the sponsors themselves aren't even employees of the issuer. And certainly you wouldn't, if you have a passive investor that's not accredited, you're not going to hire them as a W-2 employee and pay them a salary and suddenly they're an employee, you're an employee and they're knowledgeable. So it really is targeted to exist. Think of Facebook, for example.
Yeah.
Facebook, before they went public, they were raising capital. They were a startup. They had a company. Facebook had a lot of employees, not as many as they do now, but they had, tens, if not hundreds of employees. And there's probably a few of those employees who were involved in the money raising and who were really sophisticated that maybe didn't have the net worth and income. And now they would be, under this rule, they would become accredited by nature of being this knowledgeable employee. But I think for most of, at least in my world, the way we structure things for real estate syndications, I don't think that's going to be effective anyway. And then the other ones are really, the other exemptions are just kind of cleaning up a little bit of things we already knew about. Like, for example, LLCs were not part of the statute, and now they've officially become part of the statute. So things we've already knew due to some interpretations. But those are the big two ones. And again, the exciting part is not what was passed necessarily what was passed last month, but what is coming down the pipeline at any minute. It could be any day we could get not a ruling, a notice from however they do it. And they're going to issue a statement saying, hey, now go to this ABC licensed institution, go take their course, take their exam, get the certification, and now you would be accredited. You would be an accredited investor.
Yeah, it's interesting stuff. What was kind of interesting too, there was a foreign company that established questions. I had a conversation with someone. He has a company that they accept investors to, and even though they're accredited investors and they have certain income levels, they still have, I think it was a list of 5 to 10 questions that they send them, and if they can't answer those questions correctly, then then they know that they can definitely not invest or participate in the offering that they have. So it's also kind of like a screening mechanism. But it's interesting how this is unfolding, and folks that do have the knowledge and, like you said, are sophisticated, but they just didn't qualify on the basis of their income or net worth, they'll be able to participate in investments in the future. So it's pretty exciting that a big opportunity will be opened up for a lot of folks.
Yep, I totally agree, and looking forward to seeing what that looks like. Because again, I don't know if it's a weekend getaway or if it's a 6-week course. I have no idea.
You never know. Mauricio, this has been a blast. Where can folks get a copy of the book, 5 Things Every Syndicator Must Know to Stay Out of Jail? Where can people that are interested in raising capital and learning how to do that, and then also find out more about your services, where can they connect and get in touch?
Yeah, I think the ebook, if you just email me, I set up a special email. It's at jail@premierlawgroup.net. Jail@premierlawgroup.net. That'll automatically send you a copy of the book. And then if you are looking for more content or stuff, I have a YouTube channel. I'd love for you to go check that out, and subscribe would be awesome. And if you're looking to connect with me, premierlawgroup.net is our website, and there's a contact us, and I'm happy to hop on a call and run you through what you're trying to do.
Fantastic. Well, really appreciate you coming back on the show and just sharing all of this knowledge with us and giving us an update too on the accredited investor piece of it. I know I got a lot of inquiries about that from our community, so appreciate that. And for all of our listeners and viewers out there, thank you so much again for spending your most valuable resource, your time, once again with us on the show. Please check out all of our past shows. There's over 650 of them at cashflowninja.com. That's cashflowninja.com, along with community tools and resources. Until next time, live infinitely.
This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.